Hi friends, how are you all doing? Welcome once again with another topic on portfolio management. Friends, this topic is about the security market line, a very popular topic in finance. We have seen in our last video the concept of capital market line. I will give a little touch on that topic as well, but we will give more attention to security market line in this video. So friends, if you have not watched the previous video, you can see here, and for a thorough understanding of capital market line, I recommend you to go through the previous video. So friends, if this is my portfolio risk and this is my expected returns of the portfolio. So friends, we have seen this is an efficient frontier. This is an efficient frontier, and you find that the point B is the most efficient. Repeating again, what is efficient frontier? So friends, efficient frontier represents the various combination of risk and returns which are considered efficient because they give you the best return considering the risk which no other portfolios can give. So out of all the efficient, B is the most efficient. Why? You can refer to the previous video, as well as I will just have a talk on it now also. Now, if you are in any point of this frontier, means you are investing your money in risky assets. Why? Because all these points carry some degree of risk. But not necessarily that all investors will invest only in risky assets. Some investors would also like to diversify by investing a part of his or her wealth on risk-free assets. So when an investor is investing in risk-free assets, part of his money is invested in returns which is risk-free, and part of his money is invested in assets which are risky, which gives the market returns, right? So friends, I can have combination of risk-free return and risky return. I mean risk-free asset and risky assets. So if this is so, that we know that a risk-free return will only have return but no risk. So it has a starting point from here. Now if I want a return which is risk-free return, which carries no risk, and I am putting some money in risky assets, so I may make some combinations because I am not satisfied just with this risk-free return, say it is 7%. I want to increase. So what I will do, I will put some more money in risky assets. As I am going upward, it means that I am increasing my investment in risky assets, right? So as I move upward means I am taking risk, more and more risk, and I rise up and I touch this point B at a point of time, right? So you see this point and this point. This point, if I put all my money in risk-free asset. This point means when I put all money in the risky assets, right? Now this point to this point shows various combination of risk-free plus risky assets. Risk-free gives you the 7% return, say for example, and market gives you 15% returns. So you will see how much weightage, how much money you have put in risk-free assets and how much you have put in the market, okay, in risky assets, and then you will identify what is your combined return of the portfolio. So that time it will no longer, I will represent it another notation, that is C, that means combined. Why combined? Because I am combining risk-free with risk. We have also seen in our last video that this line can be extended upward. Here to here means you are making mixture of risk-free and risky assets till the time you reach B point, because as you go this side you are reaching finally the point B. This means totally risky and this is totally risk-free, and in between is a mixture of the two. If you extend this line upward, what does this mean? This means that you are making combination of risky assets and something here. This means that you are taking loan, you are borrowing to invest in risky assets. You are taking some money to borrow in risky assets. So as you go upward means you are borrowing more and more and more and more. So this is how an investor is, this part represents how an investor is constituting his portfolio in a manner that he is putting some money from his pocket as well as he is borrowing some more money so that he can invest in risky assets. Why he is doing like this? Because he can get more returns. So when you take borrowings in your portfolio, we call it as a levered portfolio. So return of a levered portfolio is quite high. It is higher than the market returns. If market is giving you 15%, it will give you say 22%. So this is what we have discussed in the previous video. I will not stretch this topic further. Just tell you, this line is the capital market line. Very neatly you can answer that capital market line shows all the combinations of risk-free assets and risky assets. The points in this line represents the returns which are lower than the returns if you put all money in the risky assets. However, the risk is also low as compared to the if all money is put in the risky assets. We have seen this in the previous video. Friends, we have seen that capital market line CML has an equation. What is that equation? Is if I have to define this equation, it is a person will get a risk-free return plus if he is here, he will get just 7 rupees. But as he moves upward, means as he goes high, he is taking some risk. Why? Because he needs some premium for taking risk. So that is RM, how much he is getting from the market, minus RF divided by the standard deviation of the market times the standard deviation of the combined portfolio. Explaining you again what is this. RF means how much you get as a risk-free return. RM minus RF means how much more you get because you have taken risk. This is a factor. This tells you that if you take 1 unit of risk, then how much will be your premium. So this is a factor and you will multiply with the total risk of your combined portfolio. So that is known as the capital market line. This is known as the slope of the capital market line, slope of CML. It is also known as the Sharpe ratio and it is also known as the reward to risk ratio, So friends, we have seen this, that this is the concept of capital market line. Now, how this is useful for me? It is useful for me because I can develop an efficient portfolio. I can make portfolio decisions, a diversified portfolio, whatever. So actually, capital market line relates to portfolio. Okay, if I have to develop an efficient portfolio, I would generally refer to the capital market line, which explains the relationship or which tells us what would be your returns if you are, or which tells us that as you take more and more risk, you get a premium for the risk taken, plus you get somewhat risk-free return. So this is the slope of this particular line. Now friends, we will move on to our discussion on security market line, because so far we have just repeated what is there in my previous video. For details, you may please refer to that video. Let's go to the security market line. Security market line. So friends, security market line is also similar, but here you see the risk is measured in terms of standard deviation. Risk is measured in terms of standard deviation. But as we have seen in our previous videos, that security risk, that is total risk, has got two components. One is the systematic risk, another is the unsystematic risk. So total risk is something that is measured in terms of standard deviation. But since total risk includes the unsystematic risk, which is not of our interest, we are not interested, we are focusing only on systematic risk. So we have diverted our attention on beta. We have seen this in our previous video. So the security market line has all to do with beta. It measures the risk in terms of beta. Okay friends, so let's see what is the equation of a security market line. So under security market line, we say, remember we are talking this in the context of the security. Here we are talking in context of a portfolio. So this is the portfolio returns, or you can say, okay fine, so this is the capital market line in the sense the equation. Okay, so here it says that if it is a return of a security X is equal to how much he is getting the risk-free return, okay, plus how much is beta times RM minus RF. So it's quite similar to this. You can see RF is there, RM minus RF is there, but the only difference is that we have taken the standard deviation of the market and the standard deviation of the portfolio, combined portfolio, whatever. So now you see, my dear friends, that here we are taking how much is my risk premium. Okay, so if I take say if I have 10 rupees as the market return and I get a 5 rupees as risk-free return, if my risk-free return is 5 rupees and this is 10 rupees minus 5, this is the premium for taking risk. Every security will get, if in the markets risk-free return means what? Suppose I have invested in the government deposit, I will get 5% returns. If I invest in market, I will get 10% returns. So that means I have invested in market, risk-free returns, 5 rupees is guaranteed, plus since I have put in market, so that's why just 5 rupees is not enough. I must get something more for the risk taken. So 10 rupees is given to me. So 10 minus 5 is my risk premium. So friends, let's see how the security market line can be helpful for an investor. So suppose this is what is your expected. Suppose your expected is 5 rupees as your risk-free return and 20 rupees as the market return. So you expect that 25 will be the return of a particular security. But what is the actual earnings of the security? You know, securities actual earning, this is as per the model. But as per the actual earnings, you get some dividend out of a security. You also get a price appreciation of the security. Okay, that means what is the dividend that the share is getting, what is the current price of the share minus what is the previous the purchase price of the share divided by purchase price of the share, and you find this is going to be 20. That means the model says that you should earn 25, but actually your security has earned 20. So there is a variation. And this variation will tell you that this security is actually overpriced. That has given you 20 rupees. You expected more as per this line. That means this particular stock X is overpriced. This concept will become more clear if I draw a line, security market line this way. And suppose this is our SML. This is our SML. Okay friends. So suppose this is a security A, this is security B, and this is security C. You can see this is the beta of the security and this is the return of the security. You can see A, B and C, they are all taking the same degree of risk. They belong to the same risk class, that is 1 beta. You can check A has got, as per the, if you are in this line, means you have met the expectation. Your expectation was 25, you got 25. But B is above. That means B has earned for you 30. B has earned 30. But as per the expectation it was 25. That means B is underpriced. As per the security market line, B is underpriced. Whereas you go to C, C you thought C will give you 25, but C has given you 15. That means C is actually overpriced. You expected 25, but actually it is giving 15. So that means your security market line can help you identify or see whether or pricing of the securities. You can see whether the securities are overpriced or underpriced. If securities meet the expectations, they are correctly priced. If it is below what is expectation, that means it is overpriced. If it is above what is expectation, means they are underpriced. So this is one of the use of security market line. So friends, in this video we have covered the concept of capital market line in a nutshell. It was already discussed in the previous video. We have now seen the concept of security market line. With these two concepts we can proceed further in our next topic. See you in the next video. Till then, goodbye.